I did not go through this example, right? Am I correct? Just anybody who has some idea about the picture. I think I did not discuss it, right? So let me start from here, right? So give me a second. Okay. So now it is recording. So, right. So let's continue from here. So we can start discussing on that. Like, so we talk about that time series data last time, and so we identify the time dependency of the data, and we want to identify that dependency structure, and then based on that, we like to predict for the future. So now, in terms of like predicting techniques, uh, we can have like several techniques we can use for that, right? So now in terms of the forecasting techniques, so initially we start from this moving average concept, and then we move on to the exponential smoothing technique as well. And then here we can see that we have that double exponential smoothing and so on, right? So the unfortunately those techniques are not available in Excel software as it is. So therefore, uh, I had to use something like the other softwares, R software and so on, right? I may just introduce you some R software and show you that how they work as well, right? I can just give some introduction to the R software, right? So now that's the idea of that, the techniques we can apply, and then also like I will go through that another technique in terms of the forecasting. That is the decomposition technique. And so I already uploaded that in both files there, so we can go through that. Uh, so so let's start from this the moving average concept. So now if you take the time series data set, so if I have that observations, say y1, y2, up to yn observations, right? So if you have a set of observations like that, then the we can see that like, so we know that these are time dependent data. So once you look at the plot of this data with respect to the time, so we can notice that there can be some kind of a plot goes like something like that, right? So we can notice, say something goes like that. So now we like to see that we can identify this particular pattern, right? And then based on that pattern, uh, we like to predict for the future, right? So we can see where is the future observations, right? We like to find out suitable points for the future values, right? So now in terms of that prediction technique, now there are many techniques we can apply. And the most commonly, you can notice that there are like the ARIMA models and so on. And so there are different types of models that are available, right? So now in terms of uh, the very basic techniques we can try first, right? So that's one of these, the moving average concept, right? So now the idea is that now we can take any consecutive observations, right? Any number of consecutive observations, and we can take the average, right? So the moving average concept means that so we can take the say yt and yt minus 1 and then divide by 2, right? So that's taking two consecutive observations and taking the average, and then we can take yt minus 1 and yt minus 2 and divide by 3, right? So you can take three consecutive values and take the average and so on, right? So you can keep on doing this for large number of observations, right? So then what we are claiming here is that so the forecasting means that based on this concept, so if you take in the two consecutive values and the average is somewhere here, right? So we like to use that particular value as a future prediction, right? So therefore, for the next observation, so this is one observation, two, and third one, right? So for the next value, so we can take the average of these two and we can predict that number as our prediction for this one. So we can see that they are not going to be same, right? So there can be some difference, right? And then take these two and take their average and use that as the prediction for the next one, right? So, and then take these two and their average as the prediction for the next one, right? And so on, right? So we can take their average, right? And use that as the prediction for the next one. So that once you do that, then you can notice that we can get some graph going like that, right? So so you can notice that that this graph may not be exactly following our time series, but there can be some similarities. And then similarly, you can do it for the three observations as well, right? So taking these three and average is somewhere here, right? So then you use that as your prediction for the next study, right? So then like that, you can do the predictions for the future values. So that's kind of like a one of the techniques we can apply, right? So the very basic techniques people are thinking about applying. So the concept is that now by looking at the consecutive values, right? So we can notice that they might have a similarity. So then we like to identify their similarity and replace that by the average, and then next consecutive values and average of them and so on, right? So replacing that the consecutive values with the average. So that's the idea of that moving average. So the average is moving over the time series, right? So now we can apply that concept and we can do that. Now, if you do it manually, of course, this is time consuming, right? So we can take a time series for an example. So I can take this particular set here, right? And then uh, I can work on that the moving average concept. And so here that starting from k equal 3 and k equal 4, and you can see that some calculation here. So let me start uh, by taking that new set of values here. So, so let me go down here and start it here. Right? So we can start from maybe like k equal 2, right? So, so that means taking the average of these two, right? And we are not going to put that number over here, but we are going to put that number over here. Taking the two consecutive values and the average of that. So I can take the average of these two and put it over there, right? And I can keep on doing that until the last observation, right? So Yeah, so we can keep on doing that, and of course now we can extend that to the future values as well, and so that is the prediction for the future as well, and so that's the taking the average of this set, right, and then predicting for the future as well, right. So that is for the k equal 2, and then you can try to equal 3. So once you're taking the average of 3, so you can apply that over here, right. So So that's the average of that one. And then let me try k equal 4 as well. So that's going to be over here. Okay, so like that, we can apply this, the averaging process. So you can see that like now each one having different values, right? So we can look at this as a graph here, right? So let me plot them and see, right? So the so we can draw the line chart here. So I can draw the line charts here. You can see that the each one having different color, and so that this is the original data, and then new set of the set of predicted values are moving like that. So that's how we can identify that our the predictions based on their moving average concept, right? So you can notice over here. So that's our original data, and you can see the predictions here based on the moving average. So that is uh, this is for the k equal 3, right? So yeah, that is for the k equal 3, and so like that, of course, we can apply this moving average concept. And now this is just the I apply it using the average function, right? And also you can notice that if you use that data analysis package here, there also you can find that moving average uh, function is there, so you can use it. So you can input your data, and so you can define that uh, which one, which order you need, as I will use that k equal 5 here, right? So, and I will say that output range is somewhere here. And they have the option of that chart output and the standard error. So I'll take the chart output, right? You can use that as well. So, okay, I just place it in the wrong place, right? I had to put it over here, right? So, the one for that. It is somewhere there, right? So that's the predictions there. And I think the chart output chart is there. This may be the chart that they are providing. So you can notice that plot going to be like that. So this is for the grade 5. So you can have both options, right? Either you can use the, the data analysis function there, or you can use uh, the actual the manually you can do the calculations. So that's how we can apply this the moving average concept. And then the once we're done with the applying this moving average concept, now you can notice that there are like k equal 2, 3, 4, 5, and so on. Right? So if you have a larger data set, of course you can increase that k up to any larger number, right? So uh, once you do that, now we have the doubt which one is going to be the most suitable out of these the different k values, right? So we need to find some calculation for that. So then the calculation we can try there is the we can use that our some error measurement to analyze the behavior of each of these predictions, right? So now we can identify several error measurements we can have, right? So we can see uh, that we can define some error measurements. So basically now what happens is whenever say I have some time series goes like that. So then these are my observed values, right? So then like if you start from k equal to then for this value, right? So your predicted value will be somewhere here, right? And then for these two, the predicted value might be somewhere here, and so on, right? So there you can see each prediction, right? The there is some difference you can identify on each prediction, right? So like that, the, for each of your predictions, there is some deviation like that. For each point, you can identify certain deviations like that. So these deviations are the our error measurements, right? So therefore, now once you have those error measurements, right? So now to compare them on when you are looking at the different models, right? So different k values, then we have different models, right? So to compare these the error values, so we can define some methods to uh, identify best one out of those the different models that we can have, right? So these are the measurements we can define there. So we can define that mean absolute deviation, right? So that means now if you look at these deviations, you can see that this is kind of like a positive deviation and this kind of like a negative deviation and so on. And so there can be, so some of them might be positive deviations and some of them might be negative deviations. So therefore, whenever you are comparing them, so if you just try to add all these error matrices, then what will happen is positives and negatives will cancel out, and then basically your error will become kind of a very small number, right? So, but we know that that's not the actual value that we are expecting. Okay, so therefore, to get a better idea about that, what are the actual deviations, right? We can take that the deviations and the absolute value, right? And then divide by the our count, right? So that is the I can define as di there and take the summation of all the deviations, right? So the deviation is defined as so we can define this as the actual value and forecasted value, right? So it is the actual. So and divide by n and taking the summation. So that is, I can put d here as well, right? So we can have that our the observed deviations, the so these are the our deviations, right? So the AD is the actual and FT is the forecasted. So the based on that, the total deviation and taking that as an average, so we can use that as the our mean absolute deviation as a measurement. Uh, to get some idea about what type of an error we can have there. And then uh, in terms of the error matrices, we can define another one as the mean square error, right? So now these are the errors that we can have. Now, one option is that we can take the absolute value. But then like practically people don't like to go for the absolute value because whenever you are trying to take the other mathematical calculations, sometimes it can be difficult. So therefore, to overcome that, we can define another measurement as the squaring. So that means the summation of deviations square and divided by n. So that's going to be our mean square, right? So like that. So that's our mean square, and then of course now once you have the mean square, the now that's we are squaring. So that means kind of like units are squared units, right? So therefore, if you like to look at the same units, then you can use the root mean square. So that's basically that our mean square and taking the square root, right? So that's the one of the measurements, and then we have that like mean absolute percentage error, in absolute percentage error. So sometimes, like when you're looking at these deviations, sometimes these deviations can depend on that the values that we are measuring as well. So if you are seeing that like these measurements are measured in terms of like thousands and so on, right? So then the this deviation will be representing in terms of thousands, right? So so then like these deviations might be kind of like a larger. And so since our values are representing in terms of the thousands, right? So to overcome that, so if you want to avoid that, these numbers are representing uh, like the getting a larger number due to that the system is like the already observations have larger values, right? So to overcome that, people introduce this mean absolute percentage error. So we are basically now taking it as a ratio, right? So mean absolute percentage error. So what we measure is that the so so we take the absolute value, right? So we take the deviations and take in the absolute value, right? And then uh, so once you are taking the absolute value, then we are trying to divide it by the observed value as well, right? So we can take that dt and divide it by the actual value. And then there are this is now once you divide by that, so this might be kind of like a very small number, and so therefore you can multiply by 100 and write it as percentage. Okay. So, and the summation, of course, right? So we have the summation as well. So then we can define it as the, and one more thing, like we need to have the divide by n as well. So we can define that in absolute percentage error defined like that. So that's the percentages are created because you divide by 80. So these are the formulas we can have there, right? The for each case, give me a second. Okay, so let's continue. So these are the formulas we can have. So you can see the in absolute percentage error and then in absolute deviations and so on, right? So what we can do is that now for each of these cases, we can calculate those measurements. I mean, absolute deviation, mean square, and so on, right? So we can calculate them one by one, and then we can see which one gives you the smallest out of them. So then we can find out that that is the best moving average order we can have. So let's do that calculation. So let me take, so we'll start from k equal to, so first thing is that, so once you have uh, the predicted values, then we can measure the error, right? So each one you can see what is the error you can find out there, right? So let's you can have the actual minus the value. And then of course the last one we don't need, right? Because that's the predicted value, right? So we can measure the error for each observation, and then we can take the absolute error, the absolute error, we can take the absolute value of each one then, and then of course we can do the calculation uh, by taking the average. So that is the mean absolute deviation. So by taking the absolute value and then taking the average, so that's going to be the mean absolute deviation. Okay. And then we need to have the squared error. So we can take the squared error, the so square of each one. So we can just calculate the square of each error, right? And then take the average. So I can just fill this out. And that's going to be the mean square error, right? And then of course I can take the square root as well. So that is the root mean square error, right? And then I can take the percentage error. So the mean absolute percentage error. The, so we need to have the absolute deviation. So I can take this number, right? So if you look at the formula here, so we can take the absolute deviation and divide it by the actual value, right? And then take the average. And you have to multiply by 100 as well, right? So I can take the absolute value here and divide by the actual value, right? So equal to the absolute value divide by the actual value here and then multiply by 100. So those are the calculations we can have. So I will remove this. And then I can take the average of that, and that is the energy. So those are the our measurements for the k equal to, right? The same thing we can do for the k equal 3 and k equal 4 and so on, right? So I let you do those calculations, right? You can try that for each value of k. So now in general, now we can see that over here in the notes. So you can see that for the k equal to 3 and 4, right? So these calculations are there. And once you look at these numbers, what can we identify? So in terms of like all three measurements here, right? The if you look at them, equal 2 is the smallest we can have. Others are getting larger, right? In terms of all three of them, right? The we can identify that the k equal 2 gives to the smallest. Everybody see that? So So that indicates, so we can use the moving average of order k equal to as our error measurement we can have here. So the order of the moving average in terms of the applying the moving average method. So you can compare that. So depending on the different time series, you will notice that so different orders will be the best, right? So you have to try it for the several orders and see it can give you the better values. Okay. So, so that's the idea of that the moving average technique. So you can try that and see that like on any time series. So you should be able to try this calculation. And then we can move on to our next calculation. That is the exponential smoothing model. So now this is kind of like another technique we can apply other than the moving average technique. So both moving average and the exponential smoothing, these are both actually smoothing techniques. So the idea of that smoothing techniques means that, so once you take the time series, so usually now if you look at the time series, so we can see that like our observations are kind of like getting some values like that. So we can notice that we have some time series goes like that, right? So then like the concept of that smoothing means that, so these are kind of like having sharp peaks like that, right? So the smoothing means that, so we are trying to find out some smooth curve representing the, right? So, so that's the idea of that like the smoothing concept. So we are always trying to find out a better curve that is representing this behavior. So we are not representing these sharp points, right? So we are trying to find out some smoother curve than that. Okay. So then with that in mind, so we can try that this smoothing technique. And then so people identified that we have that concept as the exponential smoothing, right? So that's kind of like the smoothing happens really fast or something like that, right? So indicating that as the exponential smoothing. And this particular technique we can extend up to the second level and third level as well. So we call them as the first order exponential smoothing and second order exponential smoothing and third order exponential smoothing as well. And so we can call them as the double exponential smoothing and triple exponential smoothing as well, right? So now let's just look at this formula here in terms of the smoothing technique. So if I take this formula f t plus 1 equals 1 minus alpha t plus alpha p. So that's like the one way to write down this formula, this smoothing formula we can have, right? So I mean the one should write down this order. So what does it actually happens? Now you can notice that this will depend on the alpha. So then our target is that now we have to find out suitable values for the alpha as well. So we'll see that like what are the suitable values we can have for the alpha, right? So now imagine now for a certain alpha value, then what does it mean by this calculation here? So it always depends on when you're predicting the t plus 1, it depends on the current value, the actual value, and then forecasted value for the current. So it depends on two things. And then the concept is that so we are taking the fraction of that forecasted value and then another fraction of that actual value. So it's kind of like a weighted average of these two. The actual value and then forecasted value. So and then if alpha is 0, it is totally the forecasted value. And if alpha equals 1, it is totally the actual value. So alpha equals 0 and 1 doesn't make sense that much, right? But if alpha is something between 0 and 1, we know that alpha is always between 0 and 1. So then it's kind of like a mix as the weighted average of the actual and the forecasted value for the current situation, right? So we can define the calculation like that. Okay, so that's kind of like a one way to look at this the smoothing technique. And then the if you rearrange the terms, if you factor alpha here, right? So then you will get the FT. Then I can take alpha, and then it is 80 minus FT, right? This is here, right? Right in this way. So what does this indicate basically? So now you can notice taking the difference of that. So that's their deviation, right? These are their deviations. So what we are doing is that we take some deviation and taking the part of the deviation and adding it. Is it okay? I hope you can see here, right? Okay. Right. So, so in terms of the this particular way of writing, so it is kind of like we are thinking about that error here, right? And taking the part of the error and adding it to the our forecasted value. So it's kind of like smoothing is indicated by here. So without taking the exactly that forecasted value into the future, we are adding some part of that error into that plan as well, and then it's kind of like correcting over the as the time goes by. So that's why it is kind of like smoothing is indicated. So that's the like the way that we can look at this particular concept, exponential smoothing concept, right? And then once you are looking at this technique, of course, we need to define the alpha. That is one thing we need to define. And then always you can see that the t plus 1 will depend on ft. So that means that we need to give some starting value as well. And so we have to give some initial value. And so we need to define both of them. We need to define some initial value, right? As well as some value for the alpha. Of course, we can try several values for the alpha, right? So we'll try for the different values and we need to define some initial value. So it turns out that usually that the initial value, right? The, uh, the started forecasted value we take it as the first observation. So you have like several options. You can do there, right? So starting from you can define it as zero, or you can define it as the average of some value, and any arbitrary value you can give there as initial value. So therefore, we normally take the started value as the first observation, right? So therefore, with that, the now if you look at the F2, then it is going to be so it is the F1 plus alpha times this one, right? And then the A1 and F1 are both now in this case the same. So therefore, this is going to be equal to the F1. So the F2 is equal to the F1, right? But then F3, you can notice that that will change, right? So so that's again now F1, and the match is A2 minus F1. So this is kind of like a different number, right? So you can keep on and seeing the calculations then after that, right? So that's how we can have the predicted values using the exponential smoothing technique. So now we can see that in that particular calculation over here, right? So let me show you that calculation. So I can take the number of that and the alpha equal 1, right? So now before that, we have defined that alpha equal 1. So now, of course, now you can do these calculations manually as well, but now we have that uh, the package here and the data analysis. The exponential smoothing technique is there, right? So, right. So if you go there, so I can define input values, and I can define some output range. So, so I can take the output range there, and then I can take the chart output. And now I have to give this the damping constant. The okay, I took the alpha equal 1 there, right? So, but actually I'm going to take that starting from alpha has to be between 0 and 1. So I will take it as the 0.1 and zero point 0.2 and so on. So we can try different values for the alpha. And now the important thing is that the what they are asking here is the damping factor. So that's the other uh, the alpha is kind of like the smoothing constant, right? So then like we are having that the damping value as the here. So it's kind of like the opposite of that. So therefore when alpha equals zero point 0.1, right? So the damping value will become zero point 0.9, opposite of that. And so this is 0.8. and so on. So therefore, in our calculation here, the we need to give the 0.9 there. So you can see that the predictions are there. So this is for the alpha equals 0.1, right? So, and similarly, you can take the alpha equals so, so can use that 0.8 here, and the range I can change over here. So you can see the for the alpha equal 0.2 and so on, right? You can work on that for the different alpha values. And you can see the chart output there. So for the 0.2, this is for the 0.1 and this is for the 0.2, right? The So you can notice that they're not that much closer. And so they are kind of a deviation, right? So you can try to go for the different alpha values and see which one is going to be better one, right? So, and then similarly, like in the our previous one, right? So we can do the calculation. We can do some calculation for the our error measurements as well. So let's do some calculation. So let's do some calculation for the error measurement. So let's calculate the error here. So those are the error measurements. Please give me a second. Okay. Right. So we have the error measurement here, and then uh, I can calculate the absolute error. And then taken the average. So that is the mean absolute deviation. So taking the square of here. Oh, so that's the mean square. Square root. So the mean absolute percentage error calculation. So that's absolute value divided by the actual and then multiplied by 100. So we can calculate that our error measurements like that. And some people like to look at the root mean square error because the when you are taking the in absolute error, the mean square error, so that is the we are squaring it. So in terms of the same units, you can notice that these are in the same units. I mean absolute deviation, root mean square, and in absolute percentage error, they are in the same units. And there you can see some deviations are there, right? So when you're comparing them, you of course you can see you can compare them by one of them, right? So if you are comparing in terms of mean absolute deviation, so these are the values, right? So that's the same numbers you can notice, right? So and once you're comparing them, then you can notice that some of them are the larger and some of them are smaller. So you can notice in here for the alpha equal 0.6, right? So that's where you can see the uh, where you can find the lowest numbers there in terms of the predictions. The, so that's indicating so the best alpha value we can have is 0.6. And then once you're comparing that these numbers with the other uh, over here. So that is 13.6 and so on. And so you can compare with these numbers as well, right? So and this is 14.7. So that's kind of like indicating that exponential smoothing may not be that much suitable, but moving average might be better suitable for the situation, right? So you can notice that we can compare different models using different techniques like that. And then in terms of like the now, usually we are using these error measurements to compare that within the same model, but you can use them to compare different models as well, right? But usually we are not doing that, right? But whenever you are comparing them with the different models, sometimes people like to use different measurements other than this. So for situations like that, sometimes you can notice people are using that AIC and BIC values. So those are the archival information criteria and Asian information criteria and so on. So those measurements are kind of like in general discussing the particular model. So like each of these cases now for the alpha also, each of these cases you can calculate those AIC values and BIC values and so on, right? So then by using those numbers, we can compare them with the other models as well when you are comparing moving average and the exponential smoothings, right? So those options are there as well, right? So unfortunately in Excel we don't have those, right? AIC or BIC values, but if you use other softwares, these are available there, right? So so that's the idea of that, the plot of the data, right? So you can see that the predictions here, right? So you can see that smoothing is indicating that they are not having that sharp edge and peaks like the other cases, right? So very much smoother curve than the our data, right? And then like one advantage is that now we can start from the second observation in the exponential smoothing. But in the moving average method, of course, when your odd is increasing, you are missing some values to the prediction, right? So your predictions will start later, right? So that's kind of like a disadvantage there. So there are like different advantages and disadvantages there. So and then the other option is that now uh, we can use our regression approach as well. So we can have that as the 80 plus 80 times k. So the k is the time representing, right? So therefore, we can do the forecasting using as a linear trend as well. So this is our regression formula. And then, of course, we can go for the other approaches as the double exponential smoothing and then triple exponential smoothings that you can see. So we have these AT and BT values as the values there, right? And then we are predicting the FT, right? So so generally you can see that like they are getting much complicated formulas, and the only thing is that we have to define some alpha and beta both, right? And we need to have some initial value there in terms of the two values, right? So so we can have to define some alpha value, right? So and the important thing here is that we need to have two starting values, okay? For the A and for the B, and so for both the alpha and beta of course, right? So we need to have some the starting values for them. So and then of course now in Excel we don't have this, so we'll use the R software to do it. The and then the other like the whole twin-term model is kind of like the triple exponential smoothing. So that is the including the uh, the, the seasonal pattern as well. So we can include something like that. We can have it like that as the additive model and the multiplicative models, right? And then in general, of course, we can define that uh, in terms of these different models, the without having no much trend and then no seasonality, then the moving average or the exponential smoothing works better. But when you have some seasonality and trends, then you can see that different techniques you can apply there. So people notice that these models work better than the other models. Okay, so those are the idea of like the in terms of the forecasting values we have. And I have the other file here, like this one. So, oh, wait, and this one. So I'll have this one here. Okay. So now this is the additional, like the other than those techniques we have. So and I already uploaded this Excel file as well, so you can access that. The so the now in terms of the forecasting, so these are the like the some techniques we can try, right? So this is the other methods, common techniques in is the decomposition. The decomposition technique. So in that also we can have that additive, multiplicative. So we can define two methods in terms of the decomposition, right? So now the idea of that decomposition means that now if you take any observation, so we have the observations we define as the actual values and so on, and so I can take any observation, right? AT, right? The now in terms of the decomposition means that so we like to model, right? So basically now we notice that we can look at that our data notice with our time series. So if we take any observation, then what we can notice is that so that observation includes some component as a seasonal component and then some component as a trend. And then other than that, some component as the irregular. So the other than the regular one, so that's we are defined as the irregular component. So that irregular component includes the error as well as the other any additional things there can be having, right? So we can define that as their error as well. So therefore, in terms of the decomposition, so we notice that if we take any observation, then that will have these three components, right? So I define that seasonal component, and then the trend component, and the regular component. So it includes all these three components. So that the only thing is that now we need to define that they might be blended as the additive components, or they are blended as the multiplicative components. So that's what we need to decide, right? So then if we decide that they are as the additive components, then that will become, we can define that as T plus Dt plus Id, right? And if they have the as the multiplicative components, then like that. So it can be like the various situations, they might have different formats, right? So initially we have to decide whether we are using the additive method or whether we are using the multiplicative method. So we can use either methods, right? So for our calculations here, I will show you the multiplicative method. So let's focus on this one, right? The multiplicative method, of course, you can try the additive method as well. So just the same thing, right? You have to modify it according to the additive format. So now by looking at our data set, right? So we want to separate each of these components. Of course, now the irregular component, we may not be able to uh, exactly identify, right? So we can drop that one. And then the forecasted value will become the st times tt, or in this case st plus tt. So that is going to be the forecasted values either using the additive method or multiplicative method. So that's the idea of that, our decomposition technique. And then let's see that, like, what are the steps we need to follow in order to identify this the seasonal component and the trend component and the irregular component, right? So let's identify them. So I will use that additive method, right? So I will use the multiplicative method, and we can focus on that, and then later on we can try the additive as well. So let's see that in terms of our calculations here. So first thing is that, so okay, now the just picking that one more thing, right? So the now in terms of the additive methods or the multiplicative method that we are using here, the in terms of the forecasting uh, situation here, so the now we can apply that either our the moving average concept or exponential smoothing concept. So usually that for this decomposition that people are using the moving average concept, but of course you can use that both cases there, right? So initially now we can try to go for the moving average concept, and let me go for the moving average concept. So let's apply the moving average concept in our decomposition. So now, and the idea is that now whenever you are doing the moving average, Previously, we used that moving average concept to as a prediction, right? But now we are using the moving average concept just to smooth the situation. So just as a smoothing value, right? So we are using it as a smoothing technique. So we can use that our the in terms of the exponential smoothing as well, right? So that moving average concept as a smoothing concept. So then now if I try to uh, use that now, any moving average order we can use here. Now we have to be careful a little bit on the use of the even orders, right? So we need to have that uh, centralized technique. So we need to use that centralized moving average concept if we use even orders. Okay, so that's something that we need to remember, right? So now we are using it as a smoothing technique, right? Now, for an example, now let's try that for the uh, let's try it for the order four, right? So then now that means now we can take the first four observations, right? And then use that as a prediction for the now previously we used that first four and predicted it as a fifth one. But actually now since we are taking the average, so this if you take the four of them, then they are predicting something in the middle. Right. So as the average of these four, they are basically predicting something in the middle. But unfortunately, if you take the four of them, then the average is somewhere on this line, right? So that's not including in any of these two. So that's why you need to have that centralized moving average. So now the once you take the average of the first four, and if you put it over here, if you take the average of the first two and put it over here, that means yeah, we are putting it on this line here, right? So that means like now if I take some numbers here, 4.8, 4.1, then 6, and 6.5. And so I will take these four numbers here. So if I take the average of these, the average is representing somewhere here. So that's not in the our observation line. So if you want to take that value to the what is over here, so what we need to do is that we need to use that centralized moving average concept. So what we can do is that take this average, right? And then the next four observations, right? So next four is also predicting something over here. And then if you take the average of these two, then that's predicting over here. That's representing equal to this number here. Everybody see that? So that's why we need to have that centralized moving average. So we have to go for the MA4 and then the centralized, we can define it as the doing the moving average again, right? So let me apply that moving average concept here. So we can apply that moving average for here. So now we can use that our software or manually I can do that calculation here. So let me put that number here. So I'm taking the average of these four, but now once I take the average of these four, actually I cannot put it over here, right? So I have to put it on this line here, but I cannot do it on Excel, right? So I just put it over there, and then I can keep on adding this, right? So until here, right? So that means this is indicating the average of 13 to the 16, right? So we have that the averages of all these. So basically now when you're using the moving average 4, we are missing two observations here and two here, right? So it's kind of like the disadvantage. So, but then now we need to go for the centralized moving average. So that is the now, so CMA4, the centralized concept is that now I take the average again. So taking the average of these two. So that number is the correct number representing the number 6 here. So now I can do this one here and only up to here, right? So because this is the average of these two. So 4.5. Yeah, so it is the average of these two, right? So that's the our centralized moving average value. So that means now we know that this is representing this number here, and this number here, and so on. And so each one of them, you can notice that they are representing each other, right? So, so that's the our moving average concept. By applying the moving average concept, so we are basically trying to smooth the situation. So yeah, so then we can calculate this ST times IT. So then what happens? The so let's calculate this one as the ST times IT. So what happens now? The if we are smoothing it, right? So the as you can notice that, so we are basically, now imagine now we have some data set, something goes like that, right? So we try to smooth it. So we try to find out some curve like that. So as we are smoothing it, then what actually happens is that, so we are basically removing that seasonal effects. Right? So we are just removing that any sort of like the peaks that we can have, and we are making it a kind of like a and the much more straight line. So that's why we can see that like that is kind of like representing the trend then once you smooth it. But it is including the trend and the some seasonal pattern as well. Sorry, some in the regular patterns as well, right? So therefore now, if you want to remove the trend here, right? So with that, the some calculation, right? So if you want to remove the trend, then what we can do is that the uh, we can take that, we can isolate the ST and IT, right? So so that means now since we are applying the multiplicative method, so I define that as the like that. So if you divide by this one, so you can define some trend like that. Right. So therefore, that means our the centralized moving average values is kind of like you remove the trend there, sorry, remove the seasonal pattern, right? So then you can remove the trend there by the dividing by this TF, right? So that's the so whatever that we have these numbers, we can divide by them, right? So therefore, so I can define it like that. So that means like so we just the remove that trend part from that trend, so that is including this T and IT. So now we have that. So after we have this these terms, right? So after we remove that the trend part from that, right? So we are basically having that this T and IT terms, and then from there we want to separate these T terms. So to separate these T terms, right? So we need to the average over the seasonal terms. Seasonal observations, right? So now, of course, now if you look at the data here, right? So let me do something like this. Let me plot this one. So up to this point, so these are the plots we can have, right? So initially, the so this is kind of like the light blue color one is included that the purple color one, right? So so that's the idea of that. The our smoothing, right? So you can see that it's basically flat down that our peaks, and we have a much smoother curve there, right? So therefore, we can just uh, I was just checking that whether I can remove this. We don't need that actually, this the orange color one, right? So then, of course, after removing this TNIT, the now you can see that this light green color one, it is the one that is representing STNIT. So over this one, we can see that if you take the seasonal values, so that number 4 is the one of the seasonal points. We are having the quarter data, right? So therefore, number 4 is the one season, and then 8 is another season, and then 12 is another season. So if you look at those components, then each one you can see still having some fluctuation. So that is due to the our some irregular part included in the ST and IT terms, right? So therefore, to overcome that irregular part there, what we can do is we can average over the seasonal components. So let's average that one, and that's going to be the our ST terms we can have. So that's going to be I think I can do that calculation in a separate place as well, right? So that is and in terms of ST values. So, so I can define the average over the, now if I take the third one, so then I have to take all the third ones here. So that's the average of those three. And then if I take the, oh wait. Now this is for the second quadrant, so therefore I can look at the number 2 here. Right, so I will correct the first one as well. So this to number 2 is not there. So this one. So only these two there. And this is for the one, right? So therefore one is included in. So if I take the one here, so that is the first one actually, right? And then the number 3. So number 3, I can say this one. And number 4. So like that now I can have these averages over the seasonal values, right? So I can take these numbers and then now I can use those numbers as a prediction here. So I can put them from here, right? So I just put that as the values here, right? So I can take this as my ST values as the separation of the ST term, right? So now that's my ST terms that I have, right? So then in terms of the our uh, in the in the terms there, so we can now we can notice that so we already uh, identified these two terms. Now if I take back our formula again, the so by looking at this again now, since now we have these two terms, we can divide by that. And then once you divide by that, you will ended up in this guy, right? So therefore, I can separate that one. So that becomes the observations divide by this one here. Okay. So that's the my TT times IT values. So if I plot that one as well, so, so I can do a line plot like that, right? So then you can see that the purple color one line here and is representing that TT times IT, and that's kind of like now the season pattern has gone there and it's only having some increasing pattern. If there is some increasing pattern, so that is the trend, right? So it is including the trend, but it has some deviations as well. So that is why it is including trend and the IT. So it is including both of those terms. So from that, then we can remove the trend, right? Sorry, and from that we can isolate the trend because it is including the trend as well as the error terms and so some deviations. So if you can capture those deviations and if you subtract those deviations, then you ended up in the trend line here, right? So to capture that, what we can do is that so we can predict it using our regression analysis. So we can fit a regression line, right? So for this TT times IT, right? So let me do that plotting the regression line here. So that is the basically that I'm separating the TT terms, right? So if I fit the regression line here, so I can use data analysis here and regression here. So my y variables are going to be these values here, and the x variables are I put that t here, right? So this is my x variables. So the regression line is something like this. Let me write it down. And so that is, so this is equal to the left naught plus delta 1 t. Right? So that's, I'm predicting using t, right? So that's why I'm using the regression here. So I will say that output trend is somewhere here. And I don't need any of these, right? So I just want the beta naught and beta 1. So once you do that, they're going to provide me the coefficients, beta naught and beta 1. So I can use them here as my coefficients, right? So now I can use these coefficients for this regression line here, right? So that's equal to the beta naught. I will press F4 here, right? So I'm fixing that value so by pressing F4, right? And plus beta 1 and F4 times T. So that's my regression line you can plot there. So that's the regression line you can have, right? So this is just a line, right? So then what are the missing on there, right? So that's the irregular part we have there. So to remove that irregular part, right? So basically now the irregular part is there, right? So it's the we just removed that one. And then what next we can do is that now the for the forecasting, the now as I mentioned that sorry here, right? So for the forecasting, what we need is ST times TT, right? So we already have it, right? So ST and TT we already have, right? So then we can do the forecasting here. So it's the product of these two. So that's the my forecasted values, and then of course we can extend this to the future, right? So now if I predict it for 1 year, right? Then I can extend this ST by taking these 4 and putting it there. And then trend, of course, now I can extend this line as I have that 17, 18 and so on, right? I can extend this line here and then I can extend this one. So these are my forecasted values. So then if I plot them, mm, if I just go for a line chart of this 3 only. So these are the ST terms here, right? And then uh, this the blue color one is the, let me make it bigger a little bit. So here you can see that the blue color one is the actual values, sales values, and then light blue color is the forecasted values. So you can notice that they are very close to each other, right? So this is kind of like much betterly captured the deviations. So you can notice how good they're capturing, right? So that's now therefore like we can see, we can assume the same pattern into the future, and we can see that like same trend will continue for the future as well. Okay, so that's the idea of that our predictions here. Even if we look at the actual numbers and the predicted numbers, they are close to each other, right? You can notice that. So then of course from here, uh, if you want to isolate the error, right? So that's kind of like we are not isolating the IT term, we are finding out the error, right? In terms of the XT terms, right? So therefore I can define as the error here, right? So error is going to be the actual minus the forecasted. So these are the error terms you can identify there. Okay. And with these error terms, of course, Now, if I just calculated the some of the previous measurements, mean absolute deviations and so on, right? So the absolute deviations, so these are the my mean absolute deviations. And then of course, if you square them, if I just calculate these numbers as well, the and then the mean absolute percentage error. So it is the mean absolute percentage error. And this is the mean square error. So if you look at these numbers here, right, the compared to the previous calculations, so in there you can see we get something like 13s and 14s and so on, right? So some larger deviations there. But now the here you can see these are kind of like 0.1, 0.2 and so on, right? So that's something around that numbers, right? So that's kind of like indication that how close they are, right? So that in terms of these calculations. So this decomposition technique is kind of like a much better approach compared to our uh, the moving average itself as it is, or the exponential smoothing as it is. Okay, so that's kind of like a advantage we can notice here, right? So this is kind of like a common technique you can apply. So you can work on that, and then of course if you're using some the even so the orders here, like order number 3 or order number 5 or something like that, then you don't need decentralization. Just you can take the average and represent the correct cell there and move forward from there, right? So that's something just you have to remember. So, but usually like now, since we are having the 4 quarters here, so that's why people are using moving average 4 here. But you can do the same thing with moving average 2 as well. I think I have one application here with moving average 2. Mm. And all these are moving average 4, right? Yeah. And here you can see that like this TT times IT. Sometimes we will call it as the decentralization as well, right? So as we are dividing by this one, right? And this is another calculation just using the exponential smoothing technique. So just replacing the uh, moving average by the exponential smoothing. So that's, and we have to decide some alpha value there, right? So that depends on the alpha we are using actually. So for that alpha, we can see Uh, your plot is kind of like that. So then like the blue color one and the green one is the actual and predicted. So you can see they are kind of like close to each other. So it's quite similar to the previous one, right? So they are not much deviated. So you can assume that same structure will continue for the future as well. So it depends on the alpha we are using. So we have to try this for the several alpha values and see which one is better. Okay. So that's how we can work on this the exponential smoothing technique. Okay, so now it is 3:03, right? So let's take a break. So let's come back 15 minutes. So 3:20 we start again. So and then like during that the after that like after the break, I will just introduce you the R software, right? And then we can continue with the our we can move on to the next topic as well. And I will introduce you the R software a little bit, right? And show you that the double exponential smoothings, those calculations there, right? So, and then like the addition, yeah, those are the additional things. And then I can move on to the clustering concept as well. So that's the next concept. We can move on. So, okay, I will show you the attendance. We can do the attendance as well. So during the break, you can mark the attendance. Okay. So hope all of you mark your attendance. So shall we continue? Right. So let me first introduce you the R software. So let's, so here that some of the codings for the time series and some of them are for the nutrition as well. So I will open them. Right. Right. So first of all, now in terms of the R software, right? So once you are installing the R software, uh, the first thing is that you should do first install the um, R package, right? So and then you have to install the R Studio, right? So if you just go for the R Studio download, you can see that. So if you go one of these uh, to download the R Studio, right? So there you can see that first you have to install the R, and so you have to download this one and install this one first, and then the install R Studio. So download this one and install that one. So once you install both of them, then you will have that R Studio installed into your computer. Then so you can take one of these the data sets, right? So there are so I have that data sets available there, right? I will provide you them, right? And then of course the once you install them, so you can open a folder, right? And then you can open R file there, right? So once you open the R file, and so you can I will upload this R file, and so you can uh, download it and use it. So let me uh, upload it first. So I've just uploaded those two, and then the data sets I have to check actually what are the data sets we are using. For the first file, the so this is regarding the regression work. So, so there are like several packages, yeah, and then time series. Mm, Give us a second. Something. Yeah, TS1 file, and so it's TS1 and TS2, and so I will upload them. And for the regression, there are some files. I think this one. So those were, I think, for the regression there. So, so those are the files. If I have anything else, I will upload them as well. So then what you have to do is like, so once you include those files there, so save all of them into one folder, right? So you have to make sure that all of them are in a one folder, right? So all the data files and then R codes, right? All of them are, you have to save them in a one file like this, right? So inside one folder, right? So then once you have them, then once you double click the R file, then it will open like this. And the so this here. So these are the two files I have, regression and time series. The But then like whenever you open them, you can see I have these four windows. They are presenting the date and the coding there, right? So basically now in terms of the all the writing, so we are doing it over here. So if you just use the R package without R Studio, then you will have only this part here. So there also you can type all these codes, but then we cannot go back again for one code and uh, change it. So because then we have to do it all again. So that's kind of like not user friendly that much. So that's why people have created this R Studio. So there you can type all the things here and then you can run them. So whenever you want to run a particular line, then you go to that line and press run here. And so then it will run. Or you can highlight a certain set of lines and then press run, then it will run that set of lines, right? So that's how you can run them, right? I will show you that how it works. So then that's how we can work on that our the calculations, right? So so this is kind of like so it will help us to uh, identify our data like and then like do our calculations much easily, right? One thing is that we have to find the correct coding for that, right? So we have to find these codes, and you don't need to worry too much because nowadays with the Google and then any AI software and so on, right? So those are going to provide you these codes very easily. So just you have to do the correct prompt there, and it will provide you the R code. So only thing is that we should be able to interpret them, right? So let's see that now. I will start from the time series part, right? So as you can see, we just discuss about the time series. Okay. So now in terms of the four windows here, right? So you write everything here, and then once you run them, if you're getting any errors or whether it is running properly, that is indicated over here, right? So if you're getting them in the blue color line, then it's a fine, right? It's running properly. If you're getting it in red color, that means some error is there, so you have to modify it, right? So you need to look at the code and do the corrections there, right? And then if you have any graphs as an output, it will provide over here, right? And all the data files will be available over here, right? So that's how the it is going to work, and you will see that once you are running it, right, how it is going to work. So nothing to worry about, right? Just you can type the coding and get it, and if you're getting errors, of course, you can modify them easily. And now, other than that, the other thing that we need to worry about is these packages here. So in our regular, once you're installing the R, so they usually provide you only limited packages there. So that's the kind of like the that way. your installation file is kind of a smaller, so you can easily install it, right? And then not all the people will need all those packages. There are like millions of packages there. So we are not using all of them. So for our particular work, we might have to use one or two, right? So therefore, we need to just call them whenever we are using them. And before calling them, we have to install them. So all these packages, and before you call them, of course, you have to install. So you have to install them once, right? So to install it, what you need to do is go to the tools, and you can see install packages, right? So then you can say here, and then whatever the package that you need, so you can type it here. The And this is case sensitive, right? So you have to make sure that you are typing them in the correct and the letters, right? So that is the this one and so on, right? So I already installed all these packages, right? So I don't need to do it again. But whenever you are running it first time, right? So you have to install all these packages. Just type their name and then install. And so then it will install them, right? So I will just uh, close that one, right? So you can do that. So see there are the tools, right? So there are like check for the updates as well, right? So and some other options are there as well, right? So we are not worrying too much about other options there, right? So and some other options available there, and so I just check them, right? So we will just install them, and then we can run them, right? So once you install those packages, then you have to call those whenever you are running the code, right? So library command is for the calling the packages. So I'm call these packages. So you can see they are usually they running, right? And I'm getting some warnings here, right? So these are because now having some version issues in my computer. They're not allowing me to install the newer version of the R. So that 4.3.3, I cannot install that in my computer. Some version issues. I'm having 4.3.2 actually. So that's why they're having this warning here. All these packages updated to this version. That's why, right? So for every time when I run calling a package, I will get that message, right? So and then like the now the I noticed, so you can see that like I have the data files. I already ask you to save them in the same folder, right? So like that we have the data files there. So then whenever I will open them, right? So you can see that I have the data set there, right? So number of uh, the units there, right? That's another data set there. So whenever you are installing the dataset there, the so just now you can save it as a text file or you can save it as a CSV file. Right, so you have those two options, right? And if you're using Excel, and then you have to save them as a CSV file. So then you can use this coding here to call that dataset. So let's run this one. So you can see it is in the blue color, and so that means it is running properly, and I'm just calling this TS1 file. So this is the coding when you are reading it as a text file. So then you have the read.csv here, right? So then it is the CSV file, right? And then I'm saying that header is true, right? So I have the header there, right? So in my file, I already have the header, right? So that's how I'm reading the file. And then of course, just if I want to see that, and then here that now once I read it, I am putting that into this variable TS1. So this TS1 here is a variable I'm creating inside the R, right? So I can call that and see what it is there. So you can see, so I can see my data set there. So now my data set is added into the R package, right? So then now what I'm going to do is that I want to make sure that R will identify it as a the time series data set. So it's once I just added it in the R, it's just a data set, right? So they don't know what type of a data set it is. So because now that with that data set, the time point is not allocated. So I want to allocate the time point for that. So this command, the TS command, is to allocate the time point. So I'm saying that allocating to the TS1 data file, and I'm reviewing it, recording it again into my TS1 file. That's the same file, right? And saying that I am the having the data as the frequency of 12, right? And then starting from uh, 2023 January. One is indicating January, right? So I'm asking it to label them as the data like that. So then if I run it again, then you can see I have the data starting from 2023 and going up to the 24th May, right? So that's the data set I have there. So, so then like I'm just indicating that to my file, right? So that is now this is a time series data set. So then I can try that all the techniques that we learned, right? The moving averages and then exponential smoothing. So our target is to look at the exponential smoothing. So therefore, let me introduce you the exponential smoothing technique. So SES, right? Single exponential smoothing. So SES is standard for that one, right? So that is the package. So these packages, these are coming from these packages, right? So that I have SES there, right? So, and then the whenever you are specifying the single exponential smoothing, I need to specify the alpha. So this is the alpha value that I can put any number there, right? And then h equal to is indicating that how far you want to predict. So I'm asking 2 time points into the future. I want to do the prediction. So you can change this, right? You can change it to 10 or 20, whatever, right? So that will allow you to predict for the future, right? So that is my single exponential smoothing. So let's run that one. So it's already now running, but it is not showing us any detail, right? So I want to see that detail, so I can run this one. So that's providing me the details there. So it is just giving me the details of the prediction. I'm asking them to predict for the 2 time points. So that is giving me the June and July. So because I have up to the May. So then June and July they are providing. I forecasted 60.6 and 60.6 is the same thing, right? So it is predicted as the same thing. Okay. So let's with the alpha equal 0.1 and we can change the alpha up to say 0.3. Now you can see that changes 61.6. So like that you can do the predictions, right? So and then of course we can use that the top plot command. So that's indicating the plot of the data, right? So I can see the plot here. So you can use this top plot command. It's giving me the plot of my time series and then the prediction for the future. So this blue color one here is indicating the uh, confidence interval. And so we discuss about the confidence intervals and so on. And so they are giving us the 80% as well as the 95%, right? So the larger one is the 95% gap, right? So we have these uh, in the confidence interval and the predictions is just the two numbers, right? So we have something like that. So it's basically like now that single exponential smoothing is not capturing the predictions that much. So, and I can check the accuracy as well. So let's run the accuracy, and then you can see that accuracy is indicating the mean square error, root mean square error, and so on, right? The all these measurements. So basically, like you can see the some measurements we already discussed, right? So the root mean square is that one of them, right? And the MAE is the mean absolute deviation, actual mean absolute error. That is the mean absolute deviation. And then the mean percentage error, mean absolute percentage error, and so on. And so these are the different measurements, right? And then the I have to check on what are these actually. So there are like different measurements like that. Give me a second. Okay, so give me a second. Okay, sorry. So so let's see that like under the accuracy you can see the they are giving us the those measurements we had discussed earlier, right? So now like that now you can change the alpha here, right? So if I use 0.1 here, and the accuracies uh, you can see the differences, right? So that mean absolute deviation is 13.8 and 14.6. And so the changes, right? You can change, you can see, right? So different measurements are there. So that's the idea of that our single exponential smoothing. And then the whole Winters command. The whole Winters command is for the double exponential smoothing. So under that, of course, we have the triple exponential smoothing as well. So it's basically like when you put gamma equals 0 here, there is double exponential smoothing, and you can put some value for the gamma, then it is triple exponential smoothing. So that the whole Winters method here, just I can give some values for the alpha and beta, and it is running as the double exponential smoothing. So let's run this one and see. Okay, so now what happens is that now this draw printer method with the TS1 that is saying that it is a too small time series to do the double exponential smoothing. So I had to go for a much larger one. That's why I have the second one here. So the TS2, I can see I have a larger data set here. So that is the my prediction using the single exponential smoothing, and I have the accuracy measurements like that. And then the whole printers method done. So let's try that one. Oh, it is running, right? So this is the like once you run that one, So they're giving us some coefficients. They are A and B are the two coefficients, but it's one of those field. They might be the predictions actually. So now this is the now I'm having the plot of my original data. On top of that, using this lines command, I can fit that whole printer the prediction there. And so this is indicating that the whole printer prediction there uh, in blue color, right? So using that our whole printer command there, right? So now earlier that I used that whole printers and I give the alpha and beta numbers there, right? But now if I just give the whole printers like this, they will automatically decide that values for the alpha and beta. So let's run that one. Then the predictions there, and you can see that they decided the alpha and beta and gamma all three, of course, right? So there you can see the numbers they decided, and then you can see the accuracy of that one. So now on this plot, the red color one is the that prediction. So you can see that's much better than the previous one, and you can use the accuracy command as well. I think it's there. So I'm using the accuracy command later, right? So the and then I'm trying to go with the multiplicative method and then additive method, right? So they have two methods as well for the seasonal component. So you can try them as well. So that the by default they are using the multiplicative method, actually, right? So you can notice that the yeah. So that the oh, no. By default they're using the additive one actually. So that's the red color and the purple color one are the one on top of the other one. Okay. So that's the so we can have the R coding for them, right? And then of course I want to check the accuracies as well. So you can check them using this command. So you can have the accuracies for each one using the additive method and multiplicative method. So you can see that the additive method is kind of better than the multiplicative one, right? So now that depends, right? So that's now in terms of the mean absolute deviations, it's better, right? But root mean square, it is other way. So it's kind of like, so we have to decide on that which one we are trusting. So then by default it is giving us the additive model, and so by default it is going to give me the additive model. And this is another prediction there. So using the blue color, and so they are predicting. So like this, I'm having some coding here in terms of the double exponential smoothing and the triple exponential smoothing. So you can try those techniques there. So that's how you can try the R software, right? So I just want to introduce you the R software, how we can apply that. So you can first try this, right? So you just want to try this. And in terms of your exams, I'm not going to ask you to do anything in the R software, right? So you don't have to worry about that. I'm just introducing you the R software. So just so you can try that as well, and it's better that you learn some other softwares as well other than the Excel software, right? So and this has a lot of advantages, right? And it is not so you can see it is very easy to find the coding actually, right? So if you even Google it, right, you will find the R codings, right? And then using the ChatGPT or like some the generative softwares, right? So the AI softwares, you can generate those codings as well, right? So one thing is just you should know that the regarding the your uh, subject area, you should know which. So once you have the coding, so that is you can use it in the and what as you're willing or not, right? So that you have to decide. Okay. So the once you get the coding, so you have to check and see whether it is suitable for the situation or not. So just you have to try and it's kind of like trial and error, right? So you can modify it and use it. Okay, so that's the idea of like how we can work on our time series applications in the R software, right? And then in terms of the regression software, also you can try it, right? So if you are trying the regression, then you can see I can rate that one of the data sets labeled as the milk data set, right? And so I'm reading that data set. So let's open that one and see. So this one. So I have that several variables there, right? So this is the like the multiple regression, right? So I have some variables there. So so basically I have the uh, four variables, so three variables as the independent variables and the current milk value as the my y variable, predictive variable, and the response variable, right? And these are my predictors. Okay. And for the regression, I'm using this LM command. LM stand for the linear model. Okay. So I'm generating a linear model here. So it's going to give me the coefficients, right? So let me run it and see. So that's I'm asking to fit the regression line for the new data set, right? And that summary command is giving us the summary. So if you remember the regression analysis, right? So this is the output we are getting there. So that our coefficients. So now usually we had that our ANOVA table as well. So here that unfortunately in R software they are not providing the ANOVA table. So they are directly providing the parameter estimations. So so if you look at the data here, the so you can notice that the p values you can check them, right? So that for the previous variable, right? So it is very small p value, right? And then fat variable, it is zero 0.2, so it is not the smaller one, right? And then the protein variable, 0.002, that is small. So then it starts also indicating that they are significant, and this is not significant. So that fat variable is not significant, but the other two are significant. And then you can see the R square value. So here you can look at the adjusted R square. That is 0.56. So it is kind of like we are getting only that 56%. Right? So that's not a too large number, right? So that is the how you uh, predict here, right? So then you can see the fat variable is not significant, so we can run it and without the fat variable also, and let's see what happens. So that is your summary there, right? So You can see the coefficients. Now you can see all two of them are significant and they intersect as well, right? So then your coefficient values are here. So those are the coefficient values. And then the adjusted R square, now it is 56.7, right? So now here that earlier it is 56.8, right? So that adjusted R square goes down a little bit, right? But not too much, right? So a very small number. So therefore you can see by dropping that fat variable, the R square will not change that much. So that's the kind of like the ideas you can have. And then of course, now if we do some plotting here, actually, we, so if we look at the plot of the two variables, previous and milk, right? So you can see some kind of like increasing trend there as well, right? So with the data. So there has some relationship, right? So that is indicating that so we are using previous variable, right? So it's kind of like this previous variable is kind of related to the our y variable, right? So that's indication there. So that's one of the data sets we have, and then we have that computer data set, right? So we can run that as well. And then that variable has only the two variables there. So it is simple linear regression. So we can try that. So that is the simple linear regression situation, and we can see that the p-value here that is significant, right? And here you can see that we don't need to look at the adjusted R square, we can look at the multiple R square. So that is 98%, right? So that's larger percentage is there. And of course, now this is AOV command is to indicate the analysis of variance. So this is indicating the analysis of variance table that we can have. And these are some commands we can have. Just you can look at the plot of the data. So that's the plot of the data, and we can put that line there. And then, of course, now we discuss about that our assumptions, right? So whenever you're doing the regression analysis, we have to check the assumptions. So this is how we can check the assumptions. So plot of the residuals. So this is the plot for the residuals. You can see the plot of the residuals, and uh, so these are actually the normal residuals. We need the standardized residuals actually, right? So we'll come to that later, I think. And we have this group distance as well. I think I mentioned a little bit about that. Like these are the outlier detections we can have. And then list of variance table, and so I just running them quickly, and this we don't need to worry too much about all these. And correlation testing there, right? So just doing some correlation analysis. And these are the plots we can have. So just indicating that plot of the residuals. And these are this the QQ plot and some other plot. And this is plot of the standardized residuals. And you can notice that with the standardized residuals, there you can see the all are between -2 and +2, right? So it's indicating they're okay. So, and I'm using these two libraries to run this here. And these are the standardized residuals. So clearly you can see that they are between -2 and +2. And this is another data set, supervisor data set, right? So that's I will get 6 variables there, or 7 variables, right? And that is the plot of the output there for this was the data set. So you can see that like only one of them is significant and others are not significant. So there you can see that we can do the work here. So, and like I'm not going to go into all the details there. So like we can do some modifications, but I will not do that here. So some other plots we can have here. Yeah, so just uh, showing me that how we can run the R software there. So some options you can have. So, and one more thing, I think I have this one here. So just to, yeah, this is indicating that the our t-testing here. So we discussed about that the two sample t-test and so on, right? So with equal variance and then unequal variances and so on, right? So those these are the commands we can try for them, right? So there you can see the t.test is the command that we can use there, and then different word the names you can have that paired equal true and variance equal true and so on. Those are the indications of use the equal variance, unequal variances, and so on. So I'll upload this one as well, and so that's different options we can have for the our t-testing as well. So just to give you that some idea, right? So how to use R software as well. So with that actually, so now we can end up the our discussion on uh, the R software, and then like we can go to the our next thing. So you can just we go ahead and work on the R software, and you can get some idea, right? And if you get any questions or any doubts, you can discuss with me. So, right, so with that, then I will end up the R software here, and then I can move on to the our next topic. That is this one. Okay, right. So we'll go into this one here. So, before that, I will upload this one. So now you have the data file there. So right. So now we talk about that regression analysis, and then we talk about the time series analysis, right? So now this is another area that we can talk about in terms of the different areas in statistics. So this is now the we are going to deal with the multivariate data, right? So let me introduce you that one. The under this topic, we are going to see the multivariate data analysis. So now under the multivariate data, so we are having similar type of data as the regression analysis. So in the regression analysis, we have that a y variable and bunch of x variables. But then in terms of the regression, we basically worry about the y variable, and we just take those x variables as the helping variables to the y variable. So it's kind of like a disadvantage we have because we are not using that all the properties with the x variables have. Especially now we are not worrying too much about that the variability with the our x variables and so on, right? So we are kind of like ignoring some of the details there. So to avoid those type of the loss of the data, right? So we can identify some other techniques we can apply. So that's one of the techniques is the multivariate data analysis we can have. So now this is like the not much related to the time series. So it is related to the regression analysis, right? But now this is kind of like now without worrying about that x variable and the y variable. So we are just taking that all the variables together and see their behaviors together, right? So for the multivariate data set, right? So we can just say that I have the bunch of variables x1, x2, x3 up to xn, right? So I have the bunch of variables like that. I say xk. So I have the bunch of variables x1 up to xk. So I just want to study this set of variables, how they behave together. So without taking that one by one individually, I want to take them together and see how they behave as we put them all the variables together. And so we can see some the properties of them and what is the distribution of them and so on. We can look at various properties like that. Okay, so so that is their target, and then we can know that the basically now we know that each of these variables are normal, and it's a mean mu n variance sigma square. So they coming from the normal distribution with some mean and some variance sigma square, right? So that's the each of them we can see that they are random variables, and I want to treat those variables together and see what's happening with them. So that's our target. So then of course now what are the things we can do there, right? So we need to focus on that. What are the things we can identify? So now they have multivariate data set. So if I look at the data set here, right? So I have the variables x1, x2, up to xk, right? And then if I look at my observations, right? So these are my variables. And my observations, if you look at my observations, I'm denoting them as the x11, and so on, right? So then it's oh sorry, I didn't have this as the 2 1 3 1 3 6 1 2 and so on, right? So then 3 and so on, right? So I can identify them, and then finally this I can have 1n, 2n, and then 3n and kn. So like that, I can identify the n observations, right? So the from all these are measured from one person or one object, right? So for an example, you can see now uh, I'm asking that like now I'm giving a questionnaire to each and every student, right? So I can take a sample and then I'm giving the questionnaire to all of them, right? And there I can have several questions. So I have k number of questions there. And then for each question, I'm recording your responses as x11, x21, and so on. I'm recording your responses for each question. So that's the one observation we have. So your responses for all the questions. And then the second person, their responses are the second set of observations and so on, right? So that's I have the 10 number of people there. So then all of them, the responses, I have them like that. So basically now we can see that you can put them as a matrix like that, right? It becomes a matrix like that, and you can see that is our data matrix. So we can identify our data matrix there, right? So our target is to study this data matrix, right? So now with this data matrix, of course, there are plenty of things we can do, right? So now in terms of like our previous techniques that we learn, so we can identify the distribution, right? So that we can identify that the distribution of each observation and then the distribution of entire the data set together and so on. And so we have that lot of calculations we can do like that. So, and then now that is the in terms of distribution, and then we can try the hypothesis testings and confidence intervals. The taking that these variables, right? So we can do various things like that. So that's the our idea of that our multivariate data analysis. Okay, so then the other than those the hypothesis testings and confidence intervals and various other statistical calculations, right? So we can do the regression as well, right? And then uh, some applications you can have like that as well, right? So other than that, the the next the property we can follow here is the applying this clustering concept and the factoring concept, right? So I will just tell you that. So we can apply and factor, right? So now our target is to now we'll focus on the clustering technique, of course, right? And let's see what is the difference between this clustering and the factoring, right? So now if you think about that, now we have the variables here, right? So now imagine now we give like, if you think about that, giving the questionnaire, right? So we give a, say 100 questions are there with the question. So that's like too much of questions, right? So if I give a question you with 100 questions, so then people may not be interested in, like, of course, the looking into all those 100 variables, right? So they are right. I can create 100 variables like that, right? And then, of course, some people may not be willing to answer all those 100 as well. But imagine now somehow you get some data, right? So that there are like so of course now if you have 100 variables there, then of course you need to have that the responses maybe from like 500 or 600 people, right? Or at least around that, right? So so then like imagine now you have the data, and then altogether people will not be interested in that much of knowing all those 100 variables, right? So what they want is they want to see some smaller number of variables than that. So in that case, what we can do, the we can reduce the number of variables. So, but then like we cannot drop some, right? So we just need to identify some properties and we can group them. So our target is to identify certain properties and group these variables together. So that's the our and the concept of factoring. So that we usually that we give the wording there. Now the in terms of variables, sometimes we call them as the factors as well. So that variables is another wording we use as the factors. So that's why they call it as the factor. So that the factor analysis. So sometimes we call it as the factor analysis, right? So that means the now in terms of the our variables, right? So we try to group the variables like that. So it's kind of like not one variable, and so it's kind of like bunch of variables, put them together, right? So that's called the our factoring, right? So grouping that variables together. So so basically like you can find out set of variables, say that now it is kind of like this x1 and then x10 and then x15 and then the 30 or something like that and then 90 or something like that. Then so those variables you can put them together and then they are representing one variable. And then like that you can take another set of variables and they are saying that they are representing another variable and so on. And then what we can do is like after you find out that those variables together, then you can see what is common with them, why they becomes a one variable. So then you can give some name for that based on the common properties of them. So you can define that, right? So you can find out a name for that set of variables and give a name for that. So it's like that, that you can identify various the properties and group them together. So we have some mathematical technique we can follow, right? So by using that mathematical technique, we can identify what variables we can put into one group. So that's called the that particular grouping method is the our factor analysis or factoring. Okay. And then the other one is the clustering. So then what can you see? So how do we do the clustering then? So you can identify that the so it is now why we did it in one direction, right? So we go for this direction, right? So we do the grouping from that way, and then clustering means that so you can group in this direction, right? So basically now clustering is the we cluster the observations, right? So if you take the observations, then you can put them into one groups like that. So that's called the clustering. So that's in terms of like the wording itself is telling us that. So we are finding out a cluster of the data. So that's in terms of the data, right? So we are finding some particular cluster. Right. So now that clustering we can identify if you have only two variables, right? So if you have like two or three variables, right? So then you can plot them, right? Of course, if you have two variables, you can easily plot them. And if you have three, you can go for the 3D plotting, right? So that is x1 and x2 variables. And then you can plot the data. So you can see that I have some observations here and then another set of observations over here. So we have it something like that. So the clustering means that, so I can say this is a one group and this is another group. So I can find the grouping like that, right? So that's the idea of the clustering. So they are classifying into the two groups. So that's why we call it as the clustering, finding out some clusters, right? So it is not that easily visible like that, right? So there can be like some overlappings of them and so on, right? So it's not that easy, right? So they are kind of like having that. Now we can see that like now it can be two clusters, so it can be more than two clusters, right? So sometimes you can see somewhere here and then somewhere here, somewhere here and then somewhere here, and so on. And so you can see that several clusters we can have like that, right? So it depends, right? So you can decide that what is the suitable number of clusters that you like to have, and then you can go with that. So now, if you have two variables, we can visualize, and three we can somehow visualize, but more than that, we cannot visualize. So therefore, we are in trouble of identifying what are the suitable number of the clusters we can have, right? Like two or three or four, whatever, right? So it's difficult to decide that particular number. Now, in that case, there are like several techniques you can apply. So like now there are like in terms of the clustering, we have that one thing called the hierarchical clustering, and then another one is called the non-hierarchical clustering. So if you use the hierarchical clustering, that gives us some idea about the how many clusters we can have there, right? So that there you can see initially you don't need to mention number of clusters if you're using the hierarchical clustering, but if you're using the non-hierarchical clustering, initially you have to mention how many clusters you are expected to have. Okay, so now in terms of our applications, now the things we can do using Excel, and if you focus on that, then we can apply the non-hierarchical clustering, of course. So I'm using that actually. So if you're using the hierarchical clustering, then I can go for the R software and do it. All those things we can do. We can do there as well. So depending on time, I will show you that like the what you can do in our software as well, right? But initially now I want to introduce you the how to use it in Excel. So therefore, now in terms of the techniques, right? So in terms of clustering, and in now the reason I go for the clustering because now factoring, of course, that is not available in our sorry, Excel, right? So if you try to go for the factor analysis, then definitely you have to go for the R or some other softwares, right? So, uh, but if you think about that clustering, then you can see. So we have the two techniques: hierarchical and then non-hierarchical. Okay, so we can identify the two methods like that. So in terms of the hierarchical clustering, so that you can see we can use R software and do it, right? And in the non-hierarchical clustering, so we can try it in here. That's called the k-mean clustering. So now using Excel, now I can show you that the k-mean clustering or like In other words, if you look at that, the different softwares, like different books and so on, right? They might see that K in as well, and so that's K nearest neighbor, and so it's both are the same techniques, right? So we can try to go through them. Okay, so that's the idea of that hierarchical clustering and the non-hierarchical clustering. So that under the non-hierarchical clustering, we are focusing on the k-mean method. There are other methods as well, right? So there's some statistical methods and so on. And there are like, different methods you can apply there as the non-hierarchical method as well. So let's focus on that our k-mean clustering technique, right? So now, if we go to the k-mean clustering, let's go to the so let's focus on that our k-mean clustering technique. So in terms of the our k-mean clustering, so now our target is to uh, group the variables, right? And then finding out that the what is the good representation we can have. So let's see that now as an example, if you have only two variables, right? X1 and X2, right? So I can see some set of values here. My set of observations are here. And then another set of observations are here. So I have something goes like that. So then I can see I like to put this into one group and this as another group. So I can put them into two groups like that. So then when I say that they are in two groups, what does it mean? So I'm trying to circling them. So it can be like a circle or some other shape as well, right? But my target is to circle them. So then if I'm circling them, that means they should have a center, right? So then under the k-mean method, what I will try to do is that I want to have the centers. So the center is kind of like the average of that all the observations in that cluster, right? So like the center is the once you take all these observations, they are center, right? So that's the average, right? So that's why they have the k-mean. I have the k centers, right? So I can have any number of centers like that, right? So that's the k-mean means that I'm taking that centers, right? So these are my centers. So my target is to identify these centers. So then once you identify them, then you can see how good your clustering is. So then therefore, our target now, the under the k-mean clustering means that finding out k number of centers. So I had to decide the k, right? So initially we have to decide it. Now the disadvantage is that when you look at the data, usually now just like in the previous one, if you give 100 questions there, then there are 100 variables. So we cannot visualize them. And then there can be like 1,000 observations. So we cannot visualize them. The only thing is that so we can see the so we have to decide without like getting any prior knowledge, right? So other than if you try the hierarchical methods and so on, and you can get some idea, right? So we have to decide as the our the centers. We have to decide like how many centers we are using initially, of course, right? So that number we have to decide initially, and then after you decide that number, the say now the for this example, now we decide that the so we have to decide that, right? So after you decide that, so for the value for the k, right? So that is the value for the k, right? And after you decide that k, then the now say now you decide to go for the k equal to or whatever, right? So then you have to have that some idea where you should place that k. So we need to put it in this point here and this point here. That may not be in our actual observation, right? So they're just some point in our two dimension or like in the higher dimensions. So we have to decide that what will be the suitable places for the centers, right? So the number of centers and then so we need to find those places, right, of those centers. So that means the our coordinates, right? Of course, right? So in terms of the centers, what are the coordinates of those centers? So then now, how do we do that? Of course, now we don't have like straightforward like the analytical technique to follow, but we can do some the trial and error technique. So that's called the iterative technique, right? So we will follow iterative technique. So we iteratively go through them, and then eventually we our target is to converge to that suitable value for the center, right? So we'll converge. So so basically now and you have to do several iterations of course, right? It can be like not just one or two, right? So there can be like 10 or 20 or 100 or 200 iterations, right? So the number of iterations will depend, right? So and then the so then the one of the things that we need to worry about is that so as we are looking at that our convergence here, right? So it will depend on your starting point. Now somehow now to get to this point, right? So we need to start from somewhere. We may be starting from here and here, right? Or we can start from here and here, or here and here, right? So we can start from some point. So we need to decide this starting point as well. So we have to decide what are the starting points. So usually now we are not taking any like outside points like that. Instead of that, what we do is we take some observations, say two observations, and we take them as the starting values. So it may be like now we can take if you can take two observations like that, it's better. But sometimes it may be like two observations like this, right, or two observations like this, or somewhere here, right? So it can we don't know right. So that it can be like something here and something here, right? So that's you have to decide like any two observations as the starting values, right? So we can use observations as the starting values. Okay, so we will use our observations as our starting values, right? And then iteratively we'll go through, and then what will happen is that the as we can see that like the once you separate them into the two clusters from one iteration to the other one, there will be some differences, right? And the as you go through, and then if you see that like in terms of the differences, no much, very little. So that means like the center value is in terms of that changings that you can see in the center getting smaller and smaller. So that is an indication of that you're converging, right? So you can have your starting values, and then from the second iteration, then that will change. And then next iteration, it will change again, and so on. And so after you go through that several iterations, they will change, and then you will see that they are converging to a certain number. So then we need to identify where it is converging. So we can go through several iterations, then you will see that so it is converging to these numbers. And you can clearly see that your numbers will change as you change your starting values. So we have to fix to certain starting values then. And then of course, the best thing you can do is like you can start from certain starting values, and then later on you can change that and see again whether you're converging to the same values. So like that, you can see, you can do some modifications and see where you are heading. Okay, so that you can see we have to do several things there, right? So that's the basically, so you can say that like finally I can say need to do several iterations. Okay, so it depends on situation, right? So you might have to do 10 or 20 or 30, 40, or we don't know, right? So that how many iterations we have to do. Okay, so and then like few other variations, just to tell you that once you go through that the several iterations, even after maybe 100 iterations, still like you can see it is fluctuating, right? So not easily getting converged. So if you see that like fluctuation is too much, as you go by like 100 iterations, then still too much. That means kind of like the number that you decide as the clusters may not be suitable. But you can change that and see again. Say now you go for two, and but there may be three clusters, right? So now, for example, you can see now you have one set of observations here, and another set here, and another set here. But if you think about like going two centers, then what happens? Then sometimes like maybe in one iteration you might capture one here and one here. And then the next iteration it might be somewhere here and somewhere here, right? Or somewhere here and somewhere here, right? So it can change, right? So once you having that, actually there are three clusters, but you try to go for two clusters. Then it might be like capturing this and this one, or uh, this and this one, and so on. And so it can vary. So that means as the number of clusters varying like that, that is indicating you may be uh, having the wrong number of clusters. So then you can modify it and see, right? And which will be the suitable number of clusters. So that like that you can always start from k equal 2 and then increase. So if you use the hierarchical methods, you can decide from there. That also again tells you that like, the various hierarchical methods gives you various numbers. So that means it's always in doubt. Okay, so that just the some background about that what we are doing here, right? So that's in terms of the clustering, right? So now let's move on to the clustering technique, and give me a second, of course. The Okay. So let's continue with this technique here. So now, now imagine now we have that the bunch of variables here. So I have the three variables. I'm taking three variables, age, annual income, and spending score. And I'm putting that number here, right, as the customer ID, right? So altogether I have 200 observations, right? So I have the uh, 200 observations like that. And then I think the so in terms of the observations now, if you try to uh, plot them, taking two at a time, you can see that like uh, if you use the annual income and then age, right? So I think the first variable is age, right? Yeah, annual income and age. I think I will go here. I think I have the all the plots here. Okay, okay, in here, right? I have the all three plots here. So you can see that this is the age and the spending score, right? You can see like two clusters, right? And this is the age and the annual income, and it's kind of like one cluster, right? And this is the annual income and spending score. You can see like kind of like four or five clusters. So it's like depending on that which variable that you are selecting, right? The number of clusters are changing, right? So therefore, like you can look at that. If you can have the three-dimensional plot, that might give you some idea, but it is difficult to visualize, of course, right? So now with that information, so we can have the our clustering here. So now let me work on that, right? So I will take a new sheet here and right. So I will take the observations here. So I can put them here like that. So then like now one thing I like to do is that so once you put them there, I like to label it as a table. And so we can go for the home here. And then of course now we have to select that data set and then format as a table. And we can use that. Then the it will allocate as a table, right? So just you have to select that entire data set, right? And then go to the home and format as a table, right? So you have the different options there, and you can see, right? So you can go through different options. So just you can use that, right? So they are, you can identify, they are labeling it as a table. And then if you go to the table design here, then you can see the name of the table there, right? So they are going to give us some name for that table, right? So we need to use that name as well, right? So clustering 510, right? So that's the name they are giving. You can change that as well, right? So you can change, use different names if you like. Okay, so that's how I can have the uh, table, the define my data set as a table. So I'm adding additional column here as the customer ID, right? So I need that later on, right? So that's why I'm adding it. And other than that, so I have the data set there. And then like now I will use this one here. So I have the my total number of observations, right? So I have the 200 observations, and then the and I'm decided to go for the k equal 2, right? You can decide that any number there, right? So, and then my starting clusters, right? So these are the starting centers, right? I'm just randomly selecting some observations as my two centers. So that's the totally up to you. You can even manually select two numbers as well, right? So I'm just selecting two clusters like that. So how do we use that term here? So I'm using that rand command, right? That is my random number generation command in Excel, right? So usually in the random number generation, right? So if you use that rand command there, the when you use the rand command there in Excel, so that's giving you the random number between 0 and 1, right? So you are getting, it is going to give you any random number between 0 and 1. So some decimal point. But we need to have it from the 1 to 200, right? So we have the observations from 1 to 200, right? So therefore, what I will do is first, so I can get some random number x like that, right? So I'm taking that random number and multiply by the 200, right? So that's what I'm doing here. And so I'm multiplying it by the 200, right? And then so if I just multiply my random number by 200, still I'm getting with some decimal points, right? So I'm getting something like, say 51.5, 51.1, something like that, right? I'm getting some number with some decimal points, right? So, but I need the complete integer and complete numbers, right? So therefore, to do that, I'm using this ceiling command that will give you the complete number. So the ceiling and flow means that, say now, if you're looking at the random some numbers here, right? Say for example now, so this is the 51, 52, 53, something like that, right? So if I'm getting some number here or some number here and so on and so, we are getting some numbers like that. So I'm writing it the other way, right? So this is 51, 52, and 53, right? So it's in going up like that, right? So I can get some numbers like that, right? So then what we do is that, so any number, I'm taking the ceiling. That means the upper value, right? The ceiling. And if you're getting flow, that is the lower number, right? So yeah, I'm taking that number and rounding up, to the highest number possible, right? So highest integer close to that number, right? So therefore, any number here will be the rounded up to this one, right? Anything over here rounded up to this point, and so on. All these are rounded up to 0. So like that, I'm rounding up to the closest integer value for them. So that's the idea of that using the ceiling command, right? So and then putting 1 here is indicating that the so that the putting 1 indicates, uh, give me a second. So by so so that 1 is indicating the significance. That means only up to the 1 means indicating that only the integer values, right? So that's if you put 2 there, right? So then it is giving us the decimal numbers, including the decimal numbers as well, right? So that is the rounding up to the nearest decimal point or whatever. And so that's, so we can use 1 there as the seeding command there, right? So that's giving you the rounding up to the nearest integer, right? So that's how I get the two numbers here, the as the two starting values that I like to pick. Okay, so those are my two starting values, and then I want to have uh, the starting clusters, right? So I will take this one here. So I will use this one as the starting cluster. So I think I have to use the same command over here. Oh no, sorry. I had to use vector, so going to this one. So that way you can see the same observation will be there. Okay, so that is my initial cluster. So whatever the numbers I'm getting here, so this is changing always, right? So then I want to use that the looking at this table, right? So asking to find out those observation 81 and 111, right? So like that. So I'm using this VLOOKUP command for that one, right? So I'm asking to look at this J3 value, and then like that now that table number has to be clustering 510, right? So that's table number. This was from the previous one, so that's why it has the name, different name, right? So this has to be always, I have to change for the 510. So, okay. So, so the command that we are using, we look up, right? So that's look at the J3 number and then go for the clustering 510 table, right? And then look at the second column. So this is indicating the second column, right? And then the last one is whether that we are going for range lookup. That means like whether we want to select some range here as well, right? So we did the entire column, right? We are looking at the entire column, right? So we just therefore we put it as false, right? So we just asking to look at the second column here, right? And then the they obtain that particular observation there, right? So that related to this number here, right? So that is looking at this column and then obtain the number related to this one, right? So like that, I'm asking to generate all these. So the only change is the which column that you're looking at, right? Column 2, 3, and 4, right? So we can gather that these observations as my centers. These are my initial, right? So they just I randomly pick the two observations as my centers. Okay. And then I can see the, so then I want to look at this iteration one, right? So let me look at the iteration one. So I'll just go through the iteration one and then I will stop. Okay. I want to see it. So, so I will place it over there. So So then I have only two columns. I don't need that one here, and so the so I'm having that two clusters, right? So therefore, the I'm measuring the so now, and the other thing is that now, in terms of the whenever you're looking at the clusters, right? So how do we identify whether particular observation is going to belong to that cluster or the other one? So that we can decide, right? So now, for an example, if you look at the here, right? So if you look at set of observations, right? So if I decide that, say now this has my one cluster center and this has another center, right? So then you are measuring that each observation and distance to that point, right? And then you can see if you look at these distances and this one, right? Then you can notice that the so these distances compared to these distances, so this is small, right? And then if you look at these here, right? So then these distances are compared to this one, this is a small. So therefore you can say these observations are belong to this cluster and this set of observations are belong to this cluster. So you're basically grouping them like that, right? And then what we can do is that, so once you group them, then you can re-measure the center by using that group. And you will find out some group over here, and then you remeasure the center based on them. And then you repeat the same process, right? After you remeasure the centers, then you measure distances again. And then you can see how the grouping goes on, right? So just they measure the center, right? And they measure the distances and put them into the two groups, and then recalculate the center again, and then put them into another group again and recalculate the centers again, and so on, right? So you have to keep on doing that for the several iterations. Okay, so that is going to be the process that we are going to follow. So it is now almost 5 o'clock, right? So I will stop it here then. So next time we will start from this the concept here, and we will move with the this iterative process. Okay, so I will stop it for the question.
Yeah. Can you please share the QR for again?
Sorry.
Can you please share the QR code again?
QR. Okay. Sorry. Yeah. Yeah. So I don't know whether it is working now. So it is time has gone, right? So do you want me to extend the time here? So let me see. I can change the time here, right? Yeah. You can put something like that. Now it is going to work.